Hi, Randy Pearson, Vice President of Life and Annuities for Gordon Marketing, and welcome to another episode of Selling Life and Annuities. Today with me, I've got Craig Mira, our Regional Vice President in charge of life insurance, and we're going to be talking about MECs, Modified Endowment Contracts, and why sometimes they're not necessarily a bad thing. Stay tuned. All right, Craig, modified endowment contracts in the world of life insurance. I'm sure a lot of advisors, if they're familiar with MECs, they think immediately bad thing, right? Yep. So what exactly is a MEC? Can you explain that to the agents watching this video?
Sure. So the MEC guidelines, or the 7702 guidelines, were put in place in the mid-'80s. It was defined by Congress on how they were going to define a life insurance contract, put minimum death benefits in regards to the premium while still keeping everything tax-free.
Okay, so the modified endowment contract rules stipulated by Congress, what are the effects on death benefit? I mean, what are the limits? I mean, how can you, in layman's terms, describe that to the agents?
Sure. So in layman's terms, you can think of if we have a 45-year-old male and he's paying $10,000 a year into a life insurance policy, the minimum amount of death benefit we can dial in, let's just call that $750,000. As long as we are at that $750,000 or higher, then we have not violated the MEC corridor and we have a tax-free death benefit as well as tax-free accumulation as well.
All right, so describe for agents then, in what types of scenarios, sales scenarios, would it be opportunistic or a good planning strategy to intentionally create a MEC?
Well, there's really two scenarios. The first of which is a short pay. If we have that 65-year-old and he has assets, the family has assets, and they just want to pay it in a shorter period, say they want to pay it in a lump sum or over the course of 3 years to buy $1 million of death benefit. We can pay that in a lump sum or 3 years, get the money out of the client's pocket, have it can be completely paid up, and intentionally make it a MEC. Now, even though we made it a MEC, the death benefit is still going to be tax-free.
All right, very good. So really, it's from a planning standpoint, illustration standpoint, it's about fitting the product to satisfy the client's objectives, both from a death benefit, from a life insurance standpoint, but also from a funding standpoint. Right?
Exactly.
In many instances. Now, can we create a MEC with all permanent life insurance policies, say whole life or IUL or UL?
Within any chassis. So we went over the first scenario. The second scenario would be an accumulation design that we intentionally made a MEC as well. And right now, with rates being where they're at, I'm seeing a lot of intentionally designed MECs on the accumulation side as well. If we have that 62-year-old that's looking for immediate income, we can pour in, let's just call it $500,000 into an accumulation-focused IUL, a whole life design, and turn on income in year 2. Now, that's going to have tax ramifications. The accumulation, as well as the income pulling out, will be taxed just like an annuity, but we're going to have higher upside potential within that life insurance contract. And then your death benefit is still going to be 100% tax-free, even though we created a MEC.
So in comparing a life insurance contract specifically designed as a MEC, I think you really just kind of said the words in your last statement that we're in essence creating an annuity look-alike, right? And then from a tax standpoint, the funds coming out, as I recall in some of my recent readings, it's treated as a LIFO, last in, first out, right?
Yes, sir.
So important things to keep in mind. And I think you just mentioned also IULs, understanding that in today's world and with some of the very competitive IUL products that we have out there, we've got higher caps, great return possibilities, additional bells and whistles that frequently you're not going to see in an annuity product. And from a tax standpoint, if they're treated almost identically, as long as the expenses within the life insurance contract are reasonable, I would imagine that in many instances, a well-designed MEC might be a better solution than an annuity contract.
It can be, and it's a case-by-case scenario. It's something that everyone on our team, myself, Brady, Ray, Jim, can help you go out and design and find if a MEC versus a non-MEC may be a possible solution for your client.
Yeah, you just took my last question. So my last question was going to be, how does an agent get an illustration or discuss a case? So I will, and you just told them, but I will reiterate the fact that one of the great things about Gord Marketing right now, we've taken the opportunity during this COVID pandemic to dramatically improve the quality of our marketers at Gord Marketing and the number of marketers that we have available to assist advisors. So if you're watching this video and you'd like help better understanding how to properly design life insurance cases for your scenarios, and you just simply need help from an education standpoint, an illustration standpoint, don't hesitate to reach out to Craig or any of the other number of life insurance marketers that we have working on the team. We've reached the end of this segment, run out of time. So I would ask, however, if you're watching this video, please do me a favor and click subscribe at the bottom of the video and also the notification bell so that when we roll out new content that might have a positive impact on your sales practices, that you'll be notified. But with that, thank you, Craig, for participating. Great information. And thank you for watching. Agents out there, happy selling. We'll see you next time.